Friends, let us take an example to understand the leverage. Let's say the sales made by the company is 100 and the variable cost is 50. So from sales, if we remove variable cost, what will get us known as contribution, and here it is going to be 50. And I'm going to give you the operating fixed cost is say 10. So if you remove 10 from contribution, you will get what is known as profit before interest and tax, which is 40. And from this 40, if you remove interest, let's say it's going to be 30, what you will get is known as PBT. So I have given you the numbers. The sales of 100 is finally earning profit before tax of 10. Between that, there are variable cost, operating fixed cost, and non-operating fixed cost, which is interest. So all this we have given. Now with this information, we are going to calculate three types of leverages, namely operating leverage, financial leverage, and combined leverage. So how do we calculate operating leverage? We will establish a relationship between contribution and PBIT. Contribution divided by PBIT would give operating leverage. So we'll write operating leverage is equal to contribution, which is 50, divided by PBIT, which is 40. So the operating leverage is 1.25. And what about financial leverage? We will establish relationship between PBIT and PBT. So financial leverage is PBIT divided by PBT, which is 40 divided by 10. So it is 4 times. And what about combined leverage? We have to establish relationship between contribution and PBT, or we can simply multiply operating leverage and financial leverage. Both will work. So it's going to be combined leverage is equal to contribution divided by PBT, which is 50 divided by 10 and 5. Fine. But what all these numbers convey? What do they try to convey first of all? See, what is our operating leverage? Our operating leverage was 1.25, right? This conveys the multiples is very low because the numerator was 50 and denominator was 40. So this conveys a low multiple. It means you have very little operating cost here. If the operating cost here is more, okay, from contribution, if you deduct very high level of operating cost, you will have low level of PBIT. So higher numerator and lower denominator would give you a higher ratio. So higher ratio would convey there is high level of operating cost, and lower ratio would convey there is low level of operating cost. So now you have operating leverage of 1.25, which tells you there is very low multiple, or I would say there is lesser operating fixed cost, because you had a contribution of 50, still you have a PBIT of 40. It means only 10 has been used for operating fixed cost, only 1.25 times. It means the contribution is 1.25 times of PBIT. But if the contribution is 10 times of PBIT, then it is a dangerous scenario, because the contribution has earned 10 times of PBIT. It means operating fixed cost have taken sizable portion of sizable portion of contribution. At least 9 times it had taken out. So a low multiple ratio would tell there is very little presence of leverage, and it also conveys there is a lesser operating cost. But we'll look at financial ratio. Our financial leverage was 4 times. It means PBIT divided by PBT had given 4. It means PBIT is 4 times of PBT. Is it not? PBIT is 4 times of PBT. In this case, the PBIT was 40, whereas PBT is 10. It means a sizable portion of PBIT was eaten away by non-operating fixed cost, which is basically interest. So here the financial leverage has high multiples, which conveys there is high interest cost. So higher ratio would convey presence of higher cost, and lower ratio would convey presence of lower cost. So this is about financial leverage. And what we had in combined leverage, our combined leverage ratio was 5. It means it established a relationship between contribution and PBT, right? Here when the contribution was 50 and PBT was only 10, it means the contribution has earned 5 times of PBT. It means the 4 times was eaten away by the fixed cost, basically the operating and interest cost. So the higher combined leverage indicates presence of high level of fixed cost. So that's what happened here. Though the company had low multiples in operating leverage, it had high multiples in interest cost. So the leverage ratio, basically the operating leverage, would tell you the presence of operating fixed cost. The very high fixed operating cost will also be a hindrance for growth, and financial leverage can be modified according to the capital structuring, and combined leverage will be a result of these two.